Lesson 6. Target Date versus Index Funds. Mutual funds are divided into two types: actively managed funds and passively managed index funds. For further information, see passive versus active management. Actively managed funds are managed by portfolio managers who purchase and sell assets within the fund in order to meet the fund's investment goal. Target date funds are a type of actively managed fund that is intended to mature at a certain period. Passively managed index funds simply acquire and maintain a basket of assets that also meet the fund's goal without rebalancing the portfolio. Both target date and index funds are meant to operate on autopilot, but determining which is superior necessitates an assessment of numerous aspects. Index funds. Index funds are the most basic sort of mutual fund accessible today. These funds simply buy all of the securities listed in a specific stock or bond index. For example, an S&P 500 index fund holds all 500 equities in the index, and each share of the fund reflects an undivided stake in all 500 firms. Almost every financial index, both global and local, has an index fund available for it. Target date funds. Target date funds are managed in such a way that the securities in the fund are allocated in a more cautious manner as the target date approaches. A thrift savings plan, for example, a retirement plan given by the federal government to employees, includes 5 core funds ranging from cautious to aggressive, as well as multiple life cycle funds that mature at 10-year intervals, with the next one maturing in 2020. The life cycle funds are funds of funds that hold allocations from the 5 core funds. When they are originally issued, the 2 bond funds hold 24% of the assets, with the remainder divided among the 3 stock funds from the 5 core funds. The monies are then gradually reassigned every 90 days until the goal date is met. The initial allocation is then reversed, with 24% of the money distributed to the 3 stock funds and the remaining 76% given to the 2 bond funds. Index versus TD. Target date and index funds are difficult to compare as broad fund categories since they differ in structure and goal. Internally, target date funds are often quite sophisticated entities, whereas index funds are completely transparent and static in nature. Target date funds have a wide range of cost structures, but index funds, because of their passive administration, often charge little or nothing. Target date funds may also invest in a variety of securities, such as ordinary and preferred stocks, corporate and treasury securities, and, in certain situations, other mutual funds. Furthermore, because the latter sort of fund is often structured to give greater conservative returns over time, any comparison to an index fund is inherently biased. Investors who want to compare these two types of funds will most likely need to select 2 specific funds and examine their performance over a few distinct but identical time periods. However, when viewing this data, investors should keep their objectives in mind because those who will need to access their money at a specific time, such as when the target date in question arrives, may not be good candidates for an index fund due to the possibility that the index will drop significantly just before the money is needed. Those who need to liquidate their holdings within a few years are probably better off in a target date fund, since the chances of suffering a substantial loss decrease with time, as the target portfolio gets more conservatively managed. Those who will not need to make a withdrawal for at least 15 or 20 years may benefit from an index fund. For example, a retirement saver in her 40s may be wise to buy an index fund and keep it until she's 65 or 70 because the index has posted average annual returns of 8% to 10% over that time period. Even if the market falls right before retirement, she may still outperform a target date fund since she participated in more of the gain throughout the remainder of the time period.